Well, look, you're absolutely right that it seems extremely political by the Biden administration to only really toughen up and put real sanctions on after the election when they don't have to worry about re-election and the inflationary impacts. But when we look at the Trump 2.0 administration and what that means here, I think it's very clear they're going to have an absolute maximum pressure approach on Iran, and that is going to have to uh, impact the oil exports from Iran. It's just a question of how much. And that's not going to be, I think, a matter of will by the Trump administration. It's going to be a matter of how effectively can they actually do it, and how, because Iran's now had 4 to 5 years to really finesse its expertise and capabilities to evade sanctions. But that's only one part of the equation. The other part of this is we do expect the Trump presidency wants to see lower oil prices overall, particularly to counteract any inflationary impacts they have from tariffs. And that's where this deregulatory drill baby drill policy approach to the United States comes in, where they're going to encourage a lot more domestic drilling. The concern we would have is how effective can that really be, given what's driving the pace of growth in the United States is not really regulatory factors, but it's about companies consolidating the basins, being more disciplined in their growth and returning, focused on returning cash to shareholders over production growth. And so when you see these counterbalancing effects here, while we think we want to see it, we will see a Trump administration that wants to bring on more supply. In reality, it might end up being a little bit tighter because the sanctions will have more teeth, but the regulatory or the deregulatory program they have is unlikely to have an impact, certainly in the first year.
Yeah, absolutely. I think you really hit the nail on the head, because we really have to see what Trump is going to do in reality once he is officially in the White House. Something to watch. I'm interested in sort of these more global dynamics for the oil market right now, particularly what is happening in the Middle East. It does seem like oil markets have been relatively numb to most of the developments we've seen just over the last year or so. But I mean, how are you sort of pricing in this? It does seem that there is cautious optimism on what we're seeing, particularly around Gaza and the deal around ceasefire.
Well, the reason we've seen very little market impact to events in the Middle East is because while we see a lot of headlines which pretend risk to supply, actual risk to supply hasn't materialized, right? So supply has been continuing to flow throughout the Middle East and from Russia, for that matter. And so we've seen geopolitical risk fatigue. The market's now not really believing that we're going to see an oil supply disruption until we actually see it. And so to the extent that we see de-escalation, particularly in the war with Hamas and Israel, that's not going to actually make any change to the actual oil supply that's flowing. What will have a change is those tougher Iranian sanctions. And that seems to be, in terms of what's realistically likely to happen over the next few months, regardless of whether there's a ceasefire or kind of peace process that does get traction with Israel and its neighbors. It seems like there is going to be real supply coming off the market, and any de-escalation intentions is not going to result in an increase in supply on the market. So again, it seems like these geopolitical risks, if they eventuate, are all to the upside for oil prices versus, again, a consensus expectation, which has been pretty bearish and been shrugging off these geopolitical risks for the last 24 months.